Balance sheets, where did they come from? A long time ago, there were traders, and those traders accepted goods from merchants who wanted to sell them elsewhere. And those goods or resources, also fondly known as assets or something that has future or potential value, were loaded on those ships and caravans, and the traders became responsible for them. Or they gave the merchants promises that they would look out for those resources and be able to sell them other places and would return and settle up. So the resources or assets had two pieces to them: the responsibilities to others, and then that what the trader owned as well. So the assets equaled the responsibilities or liabilities plus the capital. But in order to load the ships, there had to be two things decided upon: what the unit of measure was, so that the merchants and the traders knew what they were talking about, and what the costs of those resources were. So the traders left with the resources and then returned. And so the other side of the T account was when they returned with different resources that then discharged the responsibilities to the merchants, or the liabilities were settled up. And what was left was the trader's capital, or but the benefits they derived from the trip. So this T account of each trip, where we reduced the events to numbers, was the day of reckoning. So let's fast forward a bit. And at the Carlos Museum on the Emory campus, there are artifacts of these units of measures. And it's back behind the mummies, but the Sumerians, who were some of the first traders, and the word sum comes from Sumerians and their mathematician abilities. These are their weights and measures. Likewise, these are some of the earliest written records, and they are accounting records. Can you believe it? And those accounting records have to do with grain. And when the farmer harvested the grain, they wrote down what they were sending to market on these clay tablets. These clay tablets then got encased in some more clay, which was called the envelope, and that envelope got taken to market with the goods, and the buyers could tell whether it had been tampered with or not, because they could see if the envelope had been opened. So it's the first cybersecurity that was going on. So as you can see, there needs to be resources or assets. There needs to be a give-get or a transaction, an exchange, and there are agents, buyers, sellers, traders in the secret sauce that makes up accounting. So anything that we do, if you can reduce it to what are the resources, who's involved, who are the agents, and what is the trade or the transaction, you can do accounting. Fast forward a bit, we are in today's era where we have two sets of books: the buyer's sets of books, the seller's sets of books, and on each set of books we record from our personal perspective what the transaction is, whether we're selling it, whether we're buying it. But notice, two different sets of books that have to communicate with each other, and sometimes they don't tell the same story. Now, what is coming into being is something called blockchain. And blockchain, instead of having my books and your books, we have our books, or what's called the distributed ledger, where there's one set of books for both the buyer and the seller, and that buyer and seller transactions are accounted for in a single block. And that block is put together through what we call smart contracts, which captures not only the terms and conditions of the legal contracts, the economic events, but it also captures the accounting of it, the accounting events, the REA. So coming forward, you may see more and more blockchains or a distributed ledger. Let's recap. A balance sheet is the accounting equation. Assets equal liabilities plus owner's equity. Assets, you'll recall, are resources or something of future or potential value. Liabilities are responsibilities or promises to others. Owner's equity can be internal or external ownership. So, for example, those traders were sole proprietors who had both the internal and were internal owners. Nowadays, we have corporations where we have external owners who are known as shareholders. And so our corporate shareholders' equity accounts have something called common stock or preferred stock, which is evidence that we have sold stock to outside investors. So that's external ownership. Also, in corporations, there's internal ownership. That's profits that we have retained in our business, and those are called retained earnings or retained income. Now, an important ratio that you can always do is called the debt to equity ratio, and it talks about who controls the assets or who controls the resources, and you compute it by taking the total liabilities or those promises to others and dividing it by the total ownership. And if it's above 1, that means your creditors control your company. If it's below 1, that means you and your investors control the company and the resources. So here's some examples of balance sheets. The college shop is a sole proprietorship, and I can tell that because the owner's equity is a single account. Whereas below, this is a partnership, and I can see that because the owner's equity says partner's capital. And each individual partner will have their separate partnership account. So if you have a partnership like a limited liability partnership, you'll have hundreds of partners and hundreds of partnership accounts down there in partnership capital. Notice that for balance sheets, for whether it's sole proprietorship or a partnership, the key numbers stay the same. The assets still equal the liabilities plus the owner's equity. And you can prove that the balance sheet balances. Now, current assets are assets or resources that you believe will convert to cash in the next year or operating cycle. Property, plant, and equipment, the other PPE, is the land, the buildings, and equipment that the company has invested in. Other assets are things that are not current assets or PP&E, and they total, all that totals up to total assets. Current liabilities are your current bills or your current promises that you need to settle up in the next accounting cycle or year. Long-term liabilities are those long-term promises that you don't have to pay next year, but you will have to pay sometime, like long-term notes payable or mortgages payable. And current liabilities plus long-term liabilities equals total liabilities or total promises. And total owner's equity is just that, the ownership. Now, if I turn and look at a corporation, which arose a little bit later, it's a little more complicated. Once again, a balance sheet is a snapshot of the financial health of that business at a moment in time. So if you think about corporations the day before the coronavirus locked everything down, that financial health of that corporation looks very different than the snapshot of the financial health of that corporation a day later or a month later. So a snapshot at a moment in time is a balance sheet. It doesn't cover a period of time, but just right then. Notice for the corporation, the asset categories and the liability categories are the same, but now we're going to have shareholders' equity, and we're going to have both internal and external ownership in that stockholders or shareholders' equity. And again, we can prove that assets equal liabilities plus stockholders' equity or shareholders' equity. Now this may look familiar because you did this in a previous video, and you looked at Amazon in 2014, and you were playing treasure hunt and had to identify what the current assets are, which is right here, what the property, plant, and equipment is, which is right there, what total assets were, and then what the difference was, or adding the other assets, goodwill and other assets together, we get the 6211. Looking at current liabilities, they were kind and they totaled that up, but they did not total up total liabilities, so we had to do a little bit of math to find total liabilities and total shareholders' equity. Notice we can see the external ownership, which has to do with the stock, and the internal ownership, which has to do with the retained earnings. And again, assets equal liabilities plus shareholders' equity. Now there's another ratio that's kind of good to do, that's always done for balance sheets, and that is called the current ratio. And the current ratio takes the total current assets and divides it by the total current liabilities. And the reason you want to know what your current ratio is to see if you have enough current resources to pay your current bills or your current responsibilities. And if I do this for Amazon in 2014, notice the current ratio is 1.12, or we have just enough current assets to cover my current bills or my current responsibilities. If I compute my debt to equity ratio for 2014, notice total liabilities divided by total shareholders' equity comes out to be 4.07. So there's 4 times as much creditor involvement in my assets as there are my shareholders' equity. So who runs this company? The creditors run this company, because the creditors are the ones controlling the assets. Fast forward, where did these come from? They came from the 10K. And in your resources for this module, you will find the 10K for Amazon, now known as Alphabet, for 2018, which is the most recent one. Do not try to print this out. It's well over 100 pages long, but notice here are the financial statements that we will be covering in this course, and quite quickly. So what I'd like you to do now is to stop and try to find these key numbers again and compute the current ratio and the debt to equity ratio for 2018. Notice that Alphabet decided that they were going to go from left to right instead of right to left for the most recent financial information. So going through this, if I looked for my current assets and my property, plant, and equipment and my total assets, and then totaled up all the other things that are listed there, I would get my other assets, and finding my total liabilities. Notice now they've totaled up their total liabilities and their total shareholders' equity. I can prove that assets equal liabilities plus shareholders' equity and find all those numbers. Now, if I find my current ratio and take the current assets of 135,676. Notice these are in millions, so those are billions or trillions. And divided by current liabilities, 34,620, the current ratio now is 3.92, meaning I have almost 4 times as many current assets as I have current bills, current liabilities. So I think my financial health has changed quite a bit. If I compute my debt to equity, I take my total liabilities, which are 55,164, and divide it by my total shareholders' equity, 177,628, and and now debt to equity is way below 1, or 0.31, meaning that who controls those assets? Who controls Alphabet? It's the shareholders. It's not the creditors anymore. So as you can see, accounting does tell the story. The balance sheet does talk about the financial health of a company, and it does change over time. And in just 4 years, it changed quite a bit for Amazon or Alphabet. So these are some of the things we're going to be doing this term. What did we do? We looked at the balance sheet and account classifications that are found on the balance sheet. And we looked at where did the balance sheet come from and where's it going. So until next time,